Welcome back to our BankLite strategy video overview. This video will be in two parts. Part one, we will be talking about how you can use the BankLite strategy to earn interest on your expenses even after spending the money. Then coming soon, we will have a part two about how the BankLite strategy allows you to create a liquid asset that enhances the return on investments of different investments and protects your risk of loss. Whether your assets are the stock market, real estate, Bitcoin, whatever your chosen asset is, the BankLite strategy allows you to improve your rate of return while also decreasing your risk. But the focus for today will be part one, which is how to turn your major expenses into a tax-free asset. So for example, what that means is let's say that every year you have $100,000 in major expenses. This could be taxes or down payments on homes or properties. It could be business expenses such as payroll or reinvestment, expansion. It could be investments. Whatever it is, all of these expenses and cash flows, the BankLite strategy allows you to turn into an asset that continues to build more wealth even after the cash flow occurs. Now, for the BankLite strategy to work most efficiently, the asset that we use for the strategy needs to meet a couple of key characteristics. Number one, the asset needs to be liquid, meaning the dollars that we place into the asset for the strategy, we need to be certain that they're going to be there tomorrow. Number two, it needs to be safe, meaning the dollars that you place into the asset, we need to be certain are not going to be decreasing in value, losing value tomorrow, the next day, next month. In order to capture interest on expenses, such as taxes, even after you pay them, we need to be able to use leverage, meaning that instead of withdrawing the money from the liquidity, we can borrow against the money that you place into the asset. So when it comes to your options with these large expenses every year, you have option number one, which is what most people do. If they have $100,000 in major expenses, such as taxes, etc., they take their $100,000 and they spend it on the expense. They have the cash outflow. After this transaction occurs, they have $0 left. That is what most people do. The BankLite strategy and similar strategies is what wealthy people do. They don't spend their own money. Option number two is instead of spending your $100,000 on the expense, we instead take that $100,000 and we place it into an appreciating asset. Now this appreciating asset, again, needs to be liquid, it needs to be safe, it needs to be leverageable. Essentially the $100,000 that we place into the asset, we need to be certain that it's going to be there to pay the expense. It needs to be like a savings account with a couple of extra characteristics. Once that $100,000 is in the asset, let's say that the asset is appreciating at 10%. Well, then what we would do is we would take a secure line of credit against the asset, let's say at 5%, to then pay your expense. $100,000 goes into the asset. The asset, let's say, is earning 10%. Then we use a secure line of credit, other people's money, collateralized against the asset that you put your $100,000 into. And we use other people's money to then pay the expense. Have you ever wondered why people like Elon Musk or Jeff Bezos or the richest people that you can think of pay very, very little income tax? Well, one of the reasons is that they don't actually realize gains on their assets. They don't realize a lot of income. Instead, they take their income, they take their wealth, and they place it into appreciating assets, and then they use the bank's money. They use other people's money to then pay their expenses and to upkeep their lifestyle. This is the same concept, but on a smaller scale that the average person or above average person is able to take advantage of. The result, when we're comparing option number one and option number two, option number one, you spend your $100,000 on your expenses. At the end of the day, you have nothing left to show for it. Option number two is you take your $100,000, you buy an asset, we use other people's money to borrow against the asset with a secure line of credit, secure meaning it's collateralized, a line of credit to then pay the expense. Now this only works so long as the asset appreciates at more than the cost to borrow. So long as that remains true, it's like an employee that you pay $5,000 a month and they make you 10. So long as your employee makes you more money than it costs you, you're not going to fire the employee, right? The asset is appreciating more than the line of credit costs, then at the end of the day, you have $100,000 that's making you 10% and costing you 5. Now that's a very, very simplified example to get the point across, but if these were your only two options, $0 left after paying your expenses or $100,000 generating you a compounding 5% every year for the rest of your life, what seems like the better option? And so long as at face value, one looks better than the other, now the question is, how do we implement it? So we have to find the asset to use. And our number one asset that we use for this strategy by far is something called a max funded IUL policy. A max funded IUL policy is a life insurance policy, but max funding means that we are putting much more into the policy than the cost of the policy itself, right? We are maxing out the number of dollars, the number of premium dollars we're paying into the policy, because anything in excess of the cost of the policy goes into something like a savings account. Now, why a life insurance policy? Why would we use that? Because these dollars that go into this savings component inside of the life insurance policy create something called cash value, okay? Now, the cash value has a 6 to 8% average historical growth rate. It has no investment risk because it's not invested directly in the stock market. And so it is like a savings account risk-wise, but with a much higher return. So from a return perspective, it's certainly not bad, but the return doesn't matter. The return relative to the borrowing cost is what matters for the BankLite strategy. If we want to turn our expenses into an asset, the cost to borrow against the asset is less than what the asset is generating, what the asset is appreciating at. So a 6 to 8% average growth, no investment risk, it has a floor against loss, and all the money that you put into the account, all the growth that you receive, all the distributions that you take in the future are fully tax-free. Now, there are some scenarios where it could become taxable if you don't do it correctly, but if you use the account within the guidelines that the IRS sets, you have major tax advantages in the future. So if we just looked at the characteristics of 1 through 3, at face value, a 6 to 8% average rate of return with no investment risk, and all of your distributions in the future are fully tax-free, from an asset perspective, it's already pretty good. But this is where the strategy really falls into place. An IUL is the best fit for the strategy because it comes in with a built-in line of credit, meaning you can borrow against the policy, you can borrow against your cash value while you're earning this 6 to 8% average return without having to be approved for the loan, right? So long as you have the cash value to collateralize the loan, the line of credit, you are automatically approved by having the policy for the line of credit. Now, this line of credit has an average cost of between 4 to 5%. A little bit of it depends on interest rates over time. But the point being is that the line of credit costing you 4 to 5% is lower than the average rate of return of 6 to 8%. That is the crux that allows the BankLite strategy to work, how we can turn your major expenses into an asset. Because again, your money is going into the asset and we are using a line of credit collateralizing the asset to pay the expense. Okay? Your money is always staying in the asset forever for the rest of your life. You are only using the line of credit to pay the expenses. So here's another basic example. Let's still use the $100,000 in annual expenses, taxes, business expenses, etc. And let's say that you're 40 years old. Now these two numbers don't really matter. It could be $10,000 or $1 million, anywhere in between. And it also doesn't really matter how old you are. So let's say, for example, you're 40 years old and you did the BankLite strategy for 25 years inside of a max funded IUL policy. That means that by the time you're 65 years old, 100,000 times 25 years is $2.5 million that you've placed into the policy and that you've borrowed against the policy to pay expenses. $2.5 million of value captured inside of the policy. $100,000 into the IUL each year, $100,000 borrowed against the IUL each year to pay the expenses. Now, to be clear, this is a very simplified example. There's a couple more moving parts to be aware of, but so you understand the concept, we're assuming $100,000 in, $100,000 out to get to the $2.5 million in expenses over 25 years. So here's the projected result. Over that 25 years and running that $100,000 per year through the policy, the total interest earned is $1.54 million. $1.5 million of cash value created, $1.5 million of interest earned over that 25-year period by just running your expenses through the asset. In addition, you have the ability to turn on a tax-free income stream in the future that can last the rest of your life, and that passive tax-free income stream at that point projects at about $150,000 in this example. Now, it could be more, it could be less, it depends on numerous factors inside of the policy. But in addition, because this is a life insurance policy, there is a death benefit. There is a wealth transfer to your family, to your wife, to your kids, to your grandkids, etc. And that death benefit is also tax-free to your beneficiaries. Now, the death benefit is comprised of two pieces. There's the life insurance that you're paying for in the policy, and then there is all of the cash that you've accumulated over the course of your life, which forms a total death benefit of almost $3.5 million. So if you were to pass away at 65, not only did you accumulate $1.5 million that could be turned into $150,000 of tax-free income, but you also have $3.5 million that would be passed on to your family whenever you're gone. Now, in another conversation, we will talk about our Legacy Light strategy, which essentially sets you up a dynasty trust for your death benefit in this strategy to be paid into. so that that $3.5 million can be reinvested and continue to grow inside of a trust instead of being passed on directly to your beneficiaries, so that that wealth can continue to compound and grow for hundreds of years, creating generational wealth that can benefit your kids, your grandkids, your great-grandkids, your great-great-grandkids, etc. But more on that another day. So long as you've made it this far in the video and you're still interested in how to turn your expenses into an asset, let's talk about the logistics of setting up a max funded IUL for the BankLite strategy. Up until this point, we've been using very simplistic examples to get the point across, but as we create a foundation for education, we'll begin to build on it layer by layer so that you have a full understanding of how it works and how we set it up. So let's talk about the setup, let's talk about the logistics. Very first thing that we need to do for the strategies, we need to determine your banking goal. Your banking goal is how many dollars do you want to place into the policy with the intent to borrow against to pay expenses. We may build this around your tax burden each year. We may build it around large life events. It could be a large vacation or the purchase of a home or a property, an investment, business expansion, whatever it may be. But we need to determine the annual target for your banking goal. So far, we've been using the example of $100,000 per year going into a policy and being borrowed to pay expenses. Okay? Once we determine your banking goal, we can move on to the second step, which is establishing a cushion inside of the policy. So a cushion inside of the policy is really just a safety net for you to make sure that everything works out the way that we intend. There are a lot of moving parts in the policies. Whenever you put $100,000 into a policy, you don't necessarily have $100,000 immediately available because there's the cost of the policy that we have to consider. There's some time that it takes for the returns to be realized. And we need to make sure that you have enough money in the policy to borrow to pay the expenses that you're planning for. Now, the recommended cushion is 10 to 20% of the banking amount. Think of it as seed money or additional savings on top of the banking amount that's really just for your benefit to make sure the policy is very healthy. For example, let's say that every year you wanted to borrow $100,000 per year. That is your banking amount. Well, then you may decide I will fund $125,000 per year so that I can ensure no matter what, I have $100,000 to borrow to pay the expenses. That leaves you with about $25,000 in this example of cushion, a little bit more than the minimum recommended, but really there's no limit to what the cushion could be. And in fact, once we move into part 2 of how we use the BankLite strategy to create a liquid asset to enhance the returns of your investments and both protect your downside and improve your upside, the concept of putting additional funds into the policy inside of this cushion become more and more reasonable, more and more attractive, because the goal in that part of the strategy is to store as much liquidity as possible into a strategy that keeps your money liquid, accessible, and leverageable at the drop of a hat. Let's say that you funded $125,000 and borrowed $100,000 out every year. Now, after talking about the design logistics, now let's talk about the qualifications. So because this is a life insurance policy, you do have to be approved for the policy. And there's two parts. The first part is you need to medically qualify for the insurance. So long as you don't have cancer or cirrhosis or live an extremely unhealthy lifestyle, more than likely you will qualify. I'd say 9 out of 10 people qualify for the life insurance. Now, so long as you medically qualify, then you need to financially qualify. That comes in two parts as well. We need to be able to financially justify the amount of life insurance that we are applying for in the policy. So let's say that you make $10,000 per year and say that you want $100 million of life insurance. It doesn't really make sense based on your income, based on your assets. But then we also need to make sure that financially you can afford the policy that we're setting up. Let's say that we're setting up the policy to fund $125,000 per year to borrow $100,000 out of the policy. Well, we need to make sure that you have the income and the assets available to be able to justify funding that level of cash flow. Now, again, the size of the policy is based on your particular situation, but you do need to medically and financially qualify. Fortunately, though, this is about a 3 to 6 month process to set up from start to finish. It is a one-time setup for life. You never have to set it up again. So if you made it this far in the video and you are still interested in the BankLite concept, it's very important that you understand the timeline of getting started. Because we have somewhere between 3 to 6 months that it can take to get qualified and approved and set up in the BankLite strategy. Really, if you're interested, we can start very quickly and spend 3 to 6 months doing Q&A, making sure that all of your T's are crossed, your I's are dotted. And it's important that you know we are very education first. We need to make sure that this strategy makes sense for you. We need to explore your goals and make sure you're fully educated on how and why it can work for you. I hope that this was very educational for you and gave you some insight on how the BankLite strategy works. Be on the lookout for part 2 that talks about the BankLite strategy, creating a liquid asset to enhance the return of your investments and also protect your downside. If you're seeing this video and you're unsure of next steps, you can reach out to me or my team to schedule a call and help you get started. All right, look forward to seeing you then.